Today, financial planning, hope, is not a strategy. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Teagan Curtin. Hi, Teagan.
Hi, Martin. How are you?
Yeah, great. Thanks very much for coming on. Now, you are a financial planner, and I think this is a really, really important conversation, not least because a lot of people have no idea what a financial planner is, or if they have an idea, it'll be an old idea because, of course, things have changed in the industry quite a lot recently, right?
Absolutely. Yeah.
So let's start with a little bit about you and your background, and then we'll move on and talk specifically about financial planning and financial planners.
So I'm a financial planner with about 12 years experience. I work in the Illawarra with PRP Advisers. Although I offer investment advice and stockbroking services, I'm someone who creates financial strategies and solutions that are very specific to clients. So I work with my clients over a long-term basis, typically, rather than that transactional kind of, working. Often that you see that with the stockbroking industry, So it's more long-term financial strategies that we provide.
Right, and I think that's a really important thing to underscore, right? Because what we're talking here about is not a transactional thing, you might go in and buy or sell stocks or something, but talking more broadly about what you're trying to achieve, how you're trying to achieve it, and what levers need to be pulled. Now, if you go back a few years, financial planning got a really bad rap. Perhaps rightly, because quite often the advice that was being given was more to do with the commissions that were being paid back to the advisors, right? Now, that, of course, landscape has changed completely, hasn't it?
Well, I mean, over the last decade, we've certainly seen a huge shift in our industry, and that was with the introduction of the Future of Financial Advice, the FOFA reforms that were, incorporated into the Corporations Act. So that, and as you said, it tackled a couple of those issues. And we've also seen more recently, further reforms that are looking at increasing the education requirements in our industry and becoming more of a trusted profession, because, we see a lot of high profile things in the media, with our industry, and it certainly creates distrust. But, the FOFA reform saw the introduction of the best interest duty, which is basically that it's a legislated fiduciary duty to make sure that our clients' needs are put before our own. And that, I think, that was aimed at tackling that issue that you were talking about with, churning policies for commissions or using an approach where there were commissions paid on volume and things like that. So it's, we're certainly looking at this. The industry is changing, and it's changing in a positive way. There are positives and negatives. I think one of the negatives that we've seen of late is with the introduction of, with additional education requirements, we've also got an ethics, we have to sit an ethics exam. So it's the National Advisor exam. And there's been a lot of industry professionals who may have been in the industry for 10, 20, 30 years with so much knowledge who don't want to go back and re-educate or, so we're seeing a lot of experience exit the market, and I think that's unfortunate. But again, moving forward, when those university graduates who are educated from the onset start to get that life experience, that will be certainly a positive for the industry as well.
And I guess one of the things about having been in the industry for a long time is that people will have actually experienced downturns as well as upturns, right? Because
Absolutely.
a lot of people who've been following stocks and shares for the last few years basically have seen things just go up. The same with property, right? But unfortunately, you've got to be thinking about things can go down too, right?
There's nothing more sobering than making that phone call, Martin. I can tell you that, to talk to people when there is so much fear around, and when markets are going down, and certainly during the GFC, it was a really drawn out process. I mean, we saw the downturn recently, but there was a very quick upturn. We saw, it was a very quick recovery, whereas in something like the GFC, it wasn't as sharp. So there was a lot more fear around, especially with retirees. So it is one of those things that is something you can only really be familiar with when you've been through it, when you've had to experience those ups and downs and see the effect that it has on different people. Some people get excited about downturns, and there's not fear, there's excitement, and others will have that fear because of the time left that they have in the market, or the money that they're drawing from their portfolio. So I think that comes back to really knowing your client as well, and working with your advisors so that your overall plan is there to assist with negating, all of the volatility to some extent for your personal circumstance.
Well, there'll always be volatility, right? But your point is, it's partly an attitude of mind, right? For some people, absolutely, when prices come down, that might create an opportunity. For other people, they feel really sick when they see the dollar value reduce. It's worth remembering, of course, that there are two wonderful things about the market. Time in market, because over time in market, generally, long-term prices go up, and that's partly because of inflation and partly because of interest on interest on interest, right? Which is the compounding effect of... Now, that means that markets will tend ultimately, in the long term, to be higher rather than lower. But the journey won't be linear.
It's a roller coaster journey. That's the thing. You need to be prepared for the roller coaster and have, typically a long-term view, and also, just can block out a lot of the noise. There's so much noise in the media. There's no other asset class that's reported on the news daily, whether we're up or down. And we do, there's certainly a lot of discussion about the property market at the moment, but it's not a matter of reporting the value of your house daily on the news, So
don't start that too. We don't want that.
But it creates a real shift in sentiment on a daily basis. We see it intraday. There's swings of highs and lows, and if you're obsessing about those swings, or if you're really focused on those swings, then there's really no place for you in the market, because that's what creates the uncertainty, and that it's just, you need to be able to block out that noise, and whilst we still take into account the macro environment when we're valuing shares or deciding what investments to choose, those things are still seen, with a long-term view. We're not looking at what's happening today and trying to trade and time the market and buy the dip, and those types of things they're a part of the overall philosophy, but they can't be your driver, in choosing long-term investments. That's
so it's really interesting because you mentioned trading, right? And there is a fundamental philosophical difference between trading, which is effectively short-term moves up, short-term moves down, trying to profit. Analysis says quite often, overall, you win them half the time, right?
Yes.
Long-term investing is about having a plan, but also understanding where value lies and where value will continue to lie, right?
And fundamentals don't change. That's the thing. When you're looking at the fundamentals of a business, and I think a lot of people forget, because we're constantly looking at indexes, or indices on the market, and you forget what you're buying. You're not buying an index. You're buying pieces of companies, effectively. So, looking at the cycles that companies go through, and our economic cycles, our commodity cycles, things like that really come into play when we're talking about timing, for markets. And I think, those stock market fundamentals and company fundamentals, earnings per share and the PE ratios and things like that, they really are the things that we need to be focused on, rather than these, daily movements of the market.
Absolutely. And, sometimes I have to remind people that whilst you get all of the noise on social media from the latest trades of cryptos or et cetera, right, that really isn't about the core foundation of building wealth over time, right?
No, absolutely.
You might win some, you might lose some, but overall you probably you won't win that well. But one other question then is a financial plan, right? It takes a bit of time to put one of those together, right? And presumably there's quite a lot of iteration between yourself and the client, and you probably have to get quite a lot of information from the client to be able to really get inside their heads.
If you're putting together a solid plan, absolutely. It's about getting to know who you're putting the plan together for, what their goals are, what their risk tolerance is, because not everyone, and I think one of the things that's been really important to me in my career is not being affiliated with any particular financial institution or provider that means that I have to offer a certain a small suite of products, take a cookie cutter approach to every client. Because for me, you need to get to know, you need to ask the personal questions, and you need to drill down to what they're thinking and feeling and what their life stage is. And wealth is very different to a lot of people, and not everyone is driven by wealth accumulation. Some are driven by wealth protection or preservation. Some just are happy with the returns just above inflation, so they can feel like they're keeping up with the cost of money and the cost of living. And so it really is important to ask all of those questions. And part of that process is also determining their tolerance to risk, so where they sit on that risk return scale. Because I can put someone in high risk derivatives and hopefully achieve higher results. The higher the risk, the higher the potential return. But they're not comfortable there, and that they're not going to achieve their goals by being in that space. So you're right, it is about getting to know what it is that particular client is hoping to achieve, and also what past situations may have brought them to this point. So that there are so many things. It is a really personal approach that certainly that I take, and I think that's part of the overall process, and part of the reason why you do form those long-term relationships with clients, because you get to know them, and then for every life stage the plan might change or tweak a little bit, or the plan will be focused on a certain point in 10 years time, or 15 years time, and it could be that there are kids at home, or there are no kids and I want to accumulate wealth and I'm happy with gearing, or I'm not happy with gearing, or so there's a lot to it. More, it's not just about choosing investments. It's not about going to an advisor and saying, well, what's best in the investment market, so I'm going to choose you. It is really about someone who can see the overall picture and not take a cookie cutter approach, not just put you in a box, but actually see what it is you want to achieve through your plan. So, and the plan will change. It's not always fixed. It's a plan at a certain period of time. We project things out based on certain assumptions, but it needs to be fluid. We need to regularly review, probably on an annual basis at the bare minimum, and just make sure that we're still on track. And obviously there are macro, economic factors that will change the way we allocate certain assets. So yeah, it's something that requires review, but it is an important piece of the puzzle.
And the point about a plan is it's a plan. It will change, and things change. External factors may change, and people's circumstances change. But I think it's quite interesting if you compare that approach you've just articulated with the sort of the Robo advice, which is becoming more and more mainstream, right? Which is basically you put in a few questions and they throw you out on standard set of responses, which is absolutely a cookie cutter. And some are better than others, but still Robo advice is a very different landing point to what you're talking about, isn't it?
I think too, it comes down to the variables of input. When you're the person putting in the variables, I'm sitting here and I'm, typing in, this is what I want. Sometimes you don't have that voice of reason in that situation as well. You don't, even consider other options or know what's out in the world or in the industry. So I think those things are certainly, human contact and that human emotion will never disappear. Robo advice has a place. I think there are, certain situations where you can get valid responses and answers for questions. But I think in a broader sense, so even if you're using that as a starting point to educate yourself, and then really drilling down with an advisor, then that's probably best option, because there are just so many things and little small tweaks that might make a huge difference to your overall picture, long term especially.
So I guess there's a couple of the questions that spring to mind. The first is, as people go through their life stages, when is the time to start thinking about a financial plan? Because I have a feeling quite a few people think, oh, panic, I'm getting close to retirement, I need a plan, right? But is that too late, really?
Well, I mean, it's never too late, but it is something that is a common misconception. A lot of people think that they only need a plan when they've got a significant amount of money. And that often is the case when you're, towards the end of your working career and you've got a bit of super built up, or you've accumulated assets. But fundamentally, you've had your own plan until then. You just haven't really, you've just been taking on that whole wealth accumulation or preservation side of it yourself. So, employing someone who can steer you in directions that you may not have thought of is certainly, and I often speak to, it's funny, Martin, I speak to people a lot who, might come in and they've got a certain fear of the market, or they say, no, I'm nervous about participating in the market. I don't like the volatility of the share market. But with, mandatory superannuation in Australia, we are investors from a very young age. And, often people will choose and young investors will be choosing a default balanced or a growth fund. And, 70 to 80% of their money is in the equities market. So one of the things that I always focus on with clients is about knowing where your money is. And that can start from a very, very early age. You don't need to just have a focus when you're older. You think about, new investors, and a lot of the younger generation also have really strong ethical opinions or voices. I think with the influx of information that we have available to us now, there are a lot of people with really strong opinions about things, but yet when you talk to them, they don't know where their money is. So, how is your superannuation invested? And whether it's 10,000 or 20,000 or 200,000 or 2 million, it's still money, and that's what drives change, and it makes, decisions and policies happen. So, pointing in case I'm talking to a vegan and who was just very, very passionate about the protection of animals and very vocal, and yet looking into the superannuation environment, the person who, it was right around the Ingham's Chicken IPO, and Australian Super had taken a huge chunk in the Ingham's Chicken IPO, and this person was with Australian Super, and it just kind of highlighted that fact that if you just blindly allow someone else to take control, then you really may be choosing things that you're not comfortable with.
And of course, a lot of the big superannuation funds have very poor disclosure even now, both in terms of their investment strategies, so where they're invested, and of course also all the fees and charges that seem to accumulate without actually necessarily being fully disclosed. So there are important questions which people should be asking about their superannuation wherever they are on their life journey. But again, a lot of people will say, well, a financial plan isn't worth it until you've got a reasonable amount of money sitting in the bank. But the point is, well, actually, if you had a better financial plan, you might have actually put more money in the bank sooner.
That's true. And I do understand there is a cost involved in employing a financial planner. So you're going to, need to pay an amount for a financial plan. So you do need to be at the point where you can justify that cost. And so there is that understanding. But, there are so many things you can do to try and educate yourself before you get to that point. And as soon as you can, employing a planner who can, who'll happily work with you from that really young stage of wealth accumulation, and seeing the longer term picture is really, really imperative. And you're right, it can, small tweaks. I mean, 1% change over the course of 30 years is phenomenal when you talk about, like you said, with compounding and compounded returns, especially in superannuation. We can't touch it, till we're 60. So, well, for most of us, but it is, one of those things that people just kind of set and forget a lot of the time, and then panic about your day to day. So I think we need to address both. You need to look at your short-term money needs, but also have that long-term plan in place.
Yeah, and it's worth remembering again, of course, that fees that are drained out of accounts every year will create deterioration to returns. So sometimes those fees are worth paying because you might get a better return, but you've also got to understand that side of the equation too. And again, quite often I find that people have no idea what they're actually paying and whether they're getting value for what they're paying for.
Absolutely. It's one of the things that I address every review. What am I paying? What am I making? Is it still worth it to me? Basically, this is something, the questions that you need to be asking yourself, and also asking any advisor that you're working with, how much am I paying you? Does that justify the return? And, you're not going to get phenomenal returns every year, but you need to be thinking about whether this is something that I say, okay, well, the market may be down this year. We've had some negative return. I've still paid a fee, but, are we coming off the back of a stellar return the last year? Or so you need to average it out over the long term and realize that there are kind of swings and cycles in the market. But overall, if you yes, you're laughing because there are years where we certainly can't, as advisors, guarantee returns, but what we always focus on is asset allocation, and that's something that we drill down in when we're talking about risk tolerance. So when we're talking to a client about their attitude toward risk, that helps us determine how much of their money. So a balanced, investor might have, it's typically 50-50, but it's kind of moved towards more of a 70-30 split. So 70% of their money might be in the market and earning and growing and at risk, whereas you keep that 30% buffer of defensives, and as long as they're comfortable with that. Whereas a conservative investor might be the complete opposite and have 70% in defensives, and they might be someone who is at a life stage where they need to start drawing off on their money, and you need to have that capital security in place. So, those are the types of things, and the movements in asset allocation. For example, if our view on international equities, is more positive than domestic, then we might shift the allocation accordingly. That's where a planner can add value, because your average investor isn't all over that. You might not be able to, in your everyday life, know exactly what's happening in the US or in the domestic markets and things like that. So you just think, well, equities, there's risk and I'll have that much in there. But we might, shift over to different markets, and sometimes it'll be emerging markets, and sometimes it'll be the domestic market for franked returns. So that is where I think you see the overall benefit of a planner being able to, it's their job to assist you with that allocation.
And just one other question then, because of course a lot of people say, well, now there are so many EFTs out there that I can basically do all of that myself. Mm-hmm. What's the benefit?
Yeah, look, an ETF is an exchange-traded fund. Are those things that they typically track an index, and I think there is a place for those things in an overall portfolio. So yes, you can buy ETFs on the market and be diversified, but I think what I see, so in the ETF market, you've got those index tracking ETFs. So basically, you're just buying an ASX 200 or an S&P 500, and that's a really easy way to get into the market. But you're not really seeing the overall picture. So you're basically tracking an index. So whatever the index does is what your portfolio will do. We've also seen the introduction of a lot of sector-specific ETFs. So there's a gaming ETF, there's a crypto ETF, there are ETFs for everything. And often by the time that ETF comes to market, then it's a fairly mature kind of, there's a need for it. But that sector has already experienced a lot of growth. And it's the same thing, you see big funds or fund managers putting out their stock picks, and then people are buying them. But you need to think about when they purchase those stocks, or where, you're not getting them on entry, you're getting them at a point where people need to make money from them. And so it is about timing. I think there's a place for an ETF in a portfolio. A lot of people, and especially in our Aussie, in the domestic environment, we can often use an international ETF to create diversification, where you can't allocate a large amount of funds to specific companies. So I think it's a way to enter the market yourself as an entry point, but I don't think it's the overall picture. And I think, it's a great, it's certainly a growing part of the market in Australia domestically. We're still very new to the ETF market, but when you look globally, but I think it's positive. I use ETFs, but they aren't the only thing I use. So if we're open to a bit of diversification in certain areas, or if someone specifically wants access, there's an ETF called ACDC, which is all battery tech and lithium and all of those things. So you kind of, trying to stock pick in the lithium market is high risk, because there are so many players. It's a commodity, things like that. So getting an ETF kind of helps to hedge against that risk. So it is a way for an investor with a certain preference to have a play in that sector.
Well, I think I agree with you. There's a place for it, but you've got to ask questions about the fees as well, because sometimes the fees are a bit high, sometimes they're pretty good.
Yeah, that's right. And often, typically the fees for an ETF will be lower than a traditional managed fund, because they're listed. But it is a similar kind of structure. So you've got, at one end of the scale, the managed fund fees, they're not listed on the market. So you're buying units in a fund, and you've got that ETF structure, which is listed on the market, a little bit more transparent, because they have to, disclose everything on a daily basis. And then you've got your direct equity. So of course you have no fees for fund manager fees on a direct equity, but you also don't get that diversification. So if you can, unless you can afford to have a portfolio of diversified stocks, you also get a lot of, there's concentration risk, because if you've got a portfolio of direct equities and one company absolutely tanks, it brings down the overall picture. So again, I agree that there's a place. There are fees involved in ETFs. If the performance can outweigh that fee, it's not something to even worry about. There's a lot of people who are really fee focused, and I believe we need transparency of fees. So we need to know what we're paying for things. You need to be aware, so that you can check that it is still of value to you. You can check that the return of whatever you're paying for is valid.
It's about value for money, isn't it, rather than
Absolutely.
just the quantum of fee itself.
Yes.
Just before we finish, self-managed super funds, right? They've had a bit of a interesting ride. Quite a few people believe in them. Other people say, oh, it's actually much harder than I thought, and the fees are higher. What's your perspective on self-managed super funds?
I've dealt with self-managed super funds throughout my whole career, and I think 10 years ago it was the case where if you wanted control of your super, you had to have a self-managed super fund. Whereas now, there are a number of platforms on the market that you can take complete control of what your fund is invested in, but you don't have those fees and charges associated with the self-managed super fund. And I think a lot of people are unaware. So the attraction is control, and you can purchase assets, and a lot of the time the attraction is buying property inside your fund, and you can do that. And I think that was where we saw a big uptick in the amount of self-managed super funds coming to market, because it was a way for people to get into the property market without needing to use their own day-to-day cash flow. But there are problems with that as well. You look into retirement, and the liquidity of a property is vastly different to having an equities portfolio in there. And the other thing too, a lot of trustees of self-managed super funds don't realise that you need to have, the self-managed super fund needs to do a tax return every year. You need to have either individual trustees or a corporate trustee. So there are fees to register the company for the corporate trustee. And, you have to, if there's a property, you have to have a valuation every year. You have to have an audit every year. So there is quite a huge responsibility inside a self-managed super fund. And I think if people are aware and happy with all of that, they have great advisors and want to own a variety of assets, I think a self-managed super fund is certainly for them. I think ASIC last year, I think the minimum amount, for an advisor to put a person into a self-managed super fund is around the 300,000 mark, and that wasn't always the case. That's a kind of lift that we've seen that ASIC have required. So we need to make sure that if we are ever recommending a self-managed super fund, that we're making sure that it is in the client's best interest long term. You're not going to have a retiree set up a self-managed super fund just to own some shares, because there's no benefit there. You can have a platform, a self-managed super, a proxy to a self-managed super fund, a platform which allows you to have complete control of your shares, and still delivers the same result. So there's a place, but it's not for everyone.
And I think, once again, it's important for people to understand and go through those thinking processes rather than jumping on the latest and greatest, right? Whether it's EFTs or self-managed super or whatever,
Absolutely.
Right? And I must say, a lot of the coverage in the mainstream media is just so superficial. It doesn't ever get to some of the issues you've touched on.
I think a lot of the super comparison tools as well are, I love the transparency. I love that people are being held to account for their fees and charges, and I love that we have more knowledge available and more information available for those things, and people are becoming more aware. But what I don't love is that people aren't really comparing apples with apples in a lot of ways, and it's very misleading, and I have a lot of questions, a lot of people coming to me with questions and this is the best fund to use, and why aren't we in this, and you drill down and say, well, these are the reasons, and this is actually why we're in what we're in, and this is the performance and the fees, and there are so many things to consider. So the tools are good, but again, limited to what information is behind those valuations and results.
Absolutely. Well, as we come to the end of our conversation, Teagan, if somebody was thinking about a financial plan for the first time, what would you say was the first question they should ask themselves?
That's a good one. That's an interesting one. The first question I would hope, or the first question I tend to talk to someone when I talk to someone is what brought you here? So what actually put that idea in your head about taking control? Or, has there been a life event that's led you to this point? Or what's the driver? And ultimately, where do you want to be? So what does the end picture look like for you? Or and not the end, but what is your vision and where are you now? So I think those things are, probably where I like to start the conversation. I think if you're thinking about if you are thinking about engaging an advisor, one of the tools that is a really a positive tool on the net is the advisor register with ASIC. So you can actually go on, if you are considering engaging the services of an advisor, and this just helps, negate a lot of that fear of being taken advantage of. And I'm not saying that it's 100% foolproof, but you can go on and just in the ASIC advisor register, you just type in the advisor's name and a full history of them as an advisor comes up, so you can see what their competencies are. So you're not going to go talk to a financial advisor, such as myself, for property advice. You're going to talk to someone who is a specialist in property. So having a look at what they're competent in, what they're licensed to advise in, those types of things are freely available. You can also see if there's been any breaches against their license, any compliance breaches, who they've worked with, they chopped and changed positions, or that kind of I think helps the confidence going into seeking the services of an advisor. I think you obviously need to know about fees straight up. I think any advisor who is not open and honest about the fees that they'll charge, that's an issue. I think you need to be transparent about what you do, what benefit you can offer the person. So knowing what they're after is one thing. So making that decision about thinking to yourself, I think I really should see someone, but I don't know why. I think before you actually see someone, just have a think about the why. What is your why? And where do you see yourself? Are you someone who's excited about building wealth and accumulation for the future, or are you someone who wants security and preservation, or those types of feelings? And I think, it's funny that we're seeing a real shift of, we're seeing that uptick in education requirement, but we're focused a lot more on the behavioral sciences in our industry. So we're really, and it's an intriguing kind of a thing to be focusing on. And I've always been someone who is intrigued by people and learning about people and individuals. And I think people's attitudes towards money and themselves, or what they can and can't have. A lot of people put a lot of restrictions or limitations on themselves. So often an advisor can be there to help you shift those limitations or broaden the scope in a lot of ways, not just asset classes, but just, help you work through those, boundaries that you put up for yourself as well. So
it's good sometimes to have a sounding board and somebody to ask some slightly provocative questions, right? Because
exactly, and it's someone who can work with you to create an answer to those questions. Isn't going to just be pretentious and laugh at you or put you down or think that they know better. And I love it when I work with clients who have a strong opinion about things, because I think it's when I can learn. I learn from people myself. You're never someone who's going to know everything about everything. And when you look at that behavioral finance concept, people will not always have the same opinion as me. And, that being able to be fluid with what I'm recommending, but still, having those fundamentals behind me, of experience and, analysis is, certainly creates a good team, I think.
Excellent. Well, thanks for your time today, Teagan. If people want to follow up and chat to you further, how do they get in touch?
So PRP Advisers in Wollongong, we're on Kira Street, so you can have a look online and just reach out via email. That's probably best. My email is just Teagan@PRP Advisers.
Great. Well, I'll also put the links below. Thank you very much for your time today. Really enjoyed speaking with you and getting real insight from the coalface.
Yeah, always fun talking to you, Martin.
Thanks very much. Take care. Bye-bye.